Have you ever wondered what the perfect price for a stock is? You know, that sweet spot where a company's true value aligns with its market price. It's a question that keeps investors up at night, and today, we're diving deep into that very conundrum for a company you might use every day, Expensify. Expensify, for those unfamiliar, is a cloud-based expense management software that simplifies everything from receipt tracking to corporate card reconciliation. In a world where businesses are constantly looking for efficiency, Expensify offers a powerful solution. They've built a strong niche in the fintech space, catering to small and medium-sized businesses, and even some larger enterprises. Their platform is intuitive, widely adopted, and frankly, a lifesaver for anyone drowning in expense reports. But here's the million-dollar question: what is Expensify's target price? To figure that out, we can't just pull a number out of thin air. We need to consider a range of factors, from their financials to their market position and future growth prospects. Let's start with the fundamentals. Expensify, like many SaaS companies, operates on a subscription model, which means recurring revenue, a big plus for stability. They've shown consistent revenue growth, and while profitability can sometimes fluctuate as they invest in growth, their underlying business model is sound. We'd look at metrics like their revenue growth rate, their net dollar retention, how much existing customers are spending year over year, and their customer acquisition costs. Strong performance in these areas would suggest a higher target price. Next, we have to consider the competitive landscape. While Expensify is a leader, they're not alone. Companies like SAP Concur, Brex, and even QuickBooks offer competing solutions. Expensify's competitive advantage lies in its user-friendly interface, its focus on employee-centric expense management, and its integrations with popular accounting software. Their ability to innovate and stay ahead of the curve in this competitive environment directly impacts their long-term value. Any signs of market share erosion or slowing down of innovation would put downward pressure on a target price. Now, let's talk about future growth. Where can Expensify go from here? They could expand into new markets, offer additional financial services, or even target larger enterprise clients more aggressively. Their recent initiatives and strategic partnerships are key indicators of their growth trajectory. Are they actively expanding their product offerings? Are they entering new geographical regions? These are the kinds of questions that help us build a picture of their future earnings potential. When analysts set target prices, they often use various valuation models. Discounted cash flow, DCF, models project future cash flows and discount them back to today, giving us an intrinsic value. Relative valuation, on the other hand, compares Expensify to similar publicly traded companies based on metrics like price to sales or EV to EBITDA multiples. Both approaches have their strengths and weaknesses, and a robust target price often incorporates insights from multiple models. Given all these factors, Expensify's strong market position, recurring revenue model, consistent growth, and potential for expansion, analysts are generally optimistic. While target prices can vary significantly depending on individual assumptions, a common range for Expensify has hovered between $7 and $10 per share in recent analyses. Some see even higher potential if they execute flawlessly on their growth strategies, while others are more cautious, factoring in broader economic headwinds or increased competition. It's important to remember that a target price isn't a guarantee, it's an informed estimate. Market conditions, company performance, and unforeseen events can all impact a stock's trajectory. It's a dynamic figure that's constantly being reevaluated. With that said, thanks for watching, and until next time.